In this video, I'm going to show you a proven strategy. You can not only reduce the number of trades you take, but also boost your profit 40%. Less work and more money. It really is the best of both worlds. In the last video, we went over the Ichimoku Bounce trade. I backtested over 1,500 times on the daily and 4-hour time frame. We learned when we should use Tenkan-sen, the faster moving average, and when we should use Kijun-sen, the slower average. I showed how the strategy is wildly profitable, even when we lost between 57 and 62% of the time. Before I ran the numbers, I thought I knew what was important and what wasn't, but I was wrong. In this video, I'm going to share some surprising findings with you that'll help you make more money. The way we're going to do that is by looking at the higher daily time frame and seeing which of the signals can help us filter out the losers but still keep the winners. For example, in the last video we saw a valid short trade on the 4-hour time frame with all 6 bearish signals. When we flip over to the daily chart, we see 3 bullish signals and 3 bearish signals. As I mentioned in other videos, there are 6 main Ichimoku signals we want to look at. We want to know if price is currently inside, above, or below the current cloud, if the future cloud is red or green, where price is in relation to both the faster and the slower moving average, if the faster moving average is above or below the slower moving average, and where the lagging span is. Looking at the spreadsheet, I have a little over 1,000 bounce trades on the 4-hour time frame. For each trade, I also looked at the same candle on the daily and recorded if it agreed or not with the 4-hour signal. So for example, on the first trade, all 6 signals on the daily also agreed with the 4-hour time frame. The next trade, none of the daily signals agreed with the 4-hour. I don't want to get too far in the weeds when it comes to statistics, but it's important to know what kind of information is useful and what is just noise. Here we have 2 dots. The x-axis is height, and boys and girls are given a performance score. If the pink is the female average and the blue is the male average, can we assume the female has actually scored higher just from these 2 averages? Not necessarily. We not only want the average, but we also want to know how spread out the data is. Here we see there's a lot of overlap, so from a statistics perspective, this would not be a statistically significant difference between the 2 groups. Compare the last chart to this one. There is minimal overlap between the tails of the 2 groups. We can confidently say the results from these are statistically significant. Within a bell curve, 95% of the cases fall within 2 standard deviations. So as I go through the results and say something is significant, what I mean is there's less than a 5% chance of the groups overlapping by random chance. In a minute, I'm going to take all 1,000 cases and split them into 2 groups. The first will be when the 4-hour did not agree with the daily, and the other will be when both signals agreed. We'll compare the results from both groups. Let's say there is a significant difference in profit. What that means is when taking a trade on the 4-hour for that variable, you only want to take the trade when you get confirmation from the higher time frame. Let's go back into the data. I'll show you what I mean. We saw in the last video that a stop loss of 1.75 ATR gave the best results on the 4-hour. What we're going to do now is look at each of these 6 factors for both the TK and KJ moving averages. To get a baseline, let's look at the total starting profit using TK and KJ. You see, I backtested 1,055 trades for each, and both were around 100 R in profit. In order to compare the means, we're going to run an independent sample t-test. This first test is going to look at when the daily current Kumo disagrees or agrees with the 4-hour signal. It's a little confusing at first to read, but remember the key number in statistic is 0.05. We first look to see if there's equal variance between the groups. We see it's 0.000, which is less than 0.05, which means there's not equal variance between the groups. So we use a line that says equal variance not assumed. We now look at the SIG two-tailed columns, and if it's less than 0.05, the result is significant. If not, the difference could have happened randomly. Here the SIG is 0.011, which is larger than 0.05, so we do not have an important factor for TK. Looking at KJ 1.75, the 0.001 is less than 0.05, so we use the second row. SIG two-tail of 0.143 is greater than 0.05, which means the result is not significant. So far, this is what our table looks like. So here, for example, in the 4-hour, we get a short signal. Switching over to the daily, we notice price is also below the daily cloud, but what we've just seen from the statistics is that this does not help us predict winning and losing trades. So in the future, we can ignore this confirmation on the daily chart. We've just looked at the current cloud. Now we want to look at the future cloud. Once again, we see none of these results are significant. So far, we've seen neither number 1 or 2 are significant. Now we're going to look at where price is on the daily chart compared to the daily TK average. This time, the results are significant. Equal variance is 0.000, which is less than 0.05, so we use the second row. The SIG two-tail is 0.000, which is less than 0.05, so we do have a significant result. The same for the KJ. So here on the 4-hour, we have a long trade. Switching over to the daily, we see price is also above the TK faster moving average, so this is a trade we would want to take. On the 4-hour, we have a bounce trade to the short side. Flipping over to the daily, we see price is actually above the faster moving average, so we would not take this trade. So we just looked at the faster TK on the 24-hour. Now we want to look at the slower KJ on the 24-hour. We have a SIG two-tail of 0.002 and 0.010, which are both less than 0.05. So this factor is significant. So number 3 and 4 are significant. Let's go to the chart and see a couple examples. Here on the 4-hour, we have a short signal. Let's go to the daily and look at where price is compared to the slower moving average. The white is the slower moving average. We see we're below it. On the 4-hour, we were trying to go short, so this agrees. So we would take the trade. So here on the 4-hour, we have a short signal. When we move to the daily chart and look at the slower moving average, we also want a short signal. Here on the daily, we see price is above the slower moving average, which is a bullish signal. These two conflict, so we would not take the trade. For this last test where we use the daily KJ to filter out trades, the 1 is where the daily does not agree with the 4-hour, and the 3 is where it does agree. Notice that over 177 trades, we lost when the 4-hour and the daily said something different, but we showed an overall profit when the 2 time frames lined up. We started with over 1,000 trades, but using this one filter, we can eliminate 177 trades. And since we'll be losing less, our overall profit will be higher. We looked at the 2 moving averages separately as they related to price. Now we want to compare the 2 moving averages to each other. When the faster is above the slower, we have a bullish signal. When the faster is below, we have a short signal. Both of these are less than 0.05, so they are significant, and we want to pay attention to it on the daily chart. So TK versus KJ is important. Let's look at a couple examples. Here we have a long signal on the 4-hour. When we switch to the daily, we also want to see the faster moving average above the slower moving average. Here on the daily, the blue faster moving average is above the white slower moving average. We have a bullish signal on the 4-hour and a bullish signal on the daily, so we would take this trade. Here on the 4-hour, we have a short signal. Switching over to the daily, we see the moving averages are bullish. The faster is above the slower, so we would not take this trade. The last test we want to run is the lagging on the daily chart. Both TK and KJ are less than 0.05, so it is significant on the daily chart. Here's the completed chart, and let's look at a couple examples of the lagging span. Here on the 4-hour, we have a bullish signal. When we switch over to the daily chart, we want to see the lagging span above the price. Here on the daily, the lagging is also bullish, so we would take the trade. This time we're short on the 4-hour. We want to look at where the lagging is on the daily. Here we see lagging is above price, which is a bullish signal. We're short on the 4-hour, long on the daily, so we would not take this trade. Now, if you recall, both the TK and KJ showed a profit of about 100R over the sample of 1,055 trades. We identified 4 significant ways to use the higher time frame to filter. The goal is to eliminate some of the bad trades, which will not only raise our win rate, but also increase our overall profit. What I'm gonna do now is combine each filter and see how much more money we can make. So at a baseline, we have 1,055 trades for each. TK started with a profit of 106R and KJ with 103R. First significant factor we found was when TK agrees on the 4-hour and the daily. So notice our trades go down from 1055 to 1020, but now our profits are in the high 120Rs. So now we want to add in the KJ filter. This will only return cases where both conditions are true. For example, if we get a short signal on the 4-hour, price has to be below the fast and slow moving averages on the daily. If one of these signals does not agree, the case will be eliminated. This last test took us from 1,020 trades down to 853. We're taking over 160 trades less, but our profit increased 20R. Now we're going to see what happens when all 3 factors agree on the daily and the 4-hour, the TK, the KJ, and then the TK cross. Our trades are down to 580, but our profit went from 150 down to the 120s. It may be significant, but the TK cross does not work with our mix. It is not something we want to use. Let's delete it before we look at the last factor. So this mix is going to combine TK, KJ, and then also the lagging span. Our trades went from 853 down to 671, so we're taking about 180 less trades, while the total profit went down only 1 to 2R. These 180 trades are only slightly better than break even. For me, it's worth it to sacrifice 1 to 2R if I get to pass on monitoring 180 trades. The lagging span on the daily is something that I think is useful to keep. Here we have the 4-hour KJ 1.75 before and after we filtered using the daily time frame. As you can see, we were able to increase our win rate by reducing the bad and break-even trades. The same is true for the 4-hour TK 1.75. Dividing 31.15 by 27.58% means we increased our win rate by 13%. Here's a summary in a different format. We see the average win increased, the average loss went down, and the overall R to R went from 2.6 up to 2.8 to 1. So here's our modified chart. Once we have a valid signal in the 4-hour, we're going to look at these 3 factors on the daily chart. If we're long on the 4-hour, on the daily we want price to be above both the fast and the slow moving averages, and we want the lagging span above the candle. If we're short on the 4-hour, on the daily chart we need price below both moving averages and the lagging span below the candle. Now it's time for a pop quiz. All of these are going to be valid on the 4-hour. It's your job to filter the trades on the daily chart and say yes or no. So here we're long on the 4-hour. Switching over to the daily, would you take this trade? Price is above both moving averages, but look at the lagging span. It's below price. So we would not take this trade. So here on the 4-hour, we're going short. Would you still go short on the 4-hour looking at the daily chart? Price is below both moving averages and the lagging span is below the price. We're short on the 4-hour and we're short on the daily, so we would take this trade. Here we have a long trade on the 4-hour, and here's the daily. All three line up, and this is a trade. Here we're long on the 4-hour. What do you think about the daily? Price is above both moving averages and lagging is above the candle, so this would be a long. Another long signal on the 4-hour. Would this still be a long? Price is above the faster moving average, but two things wrong here. Price is below the slower moving average and the lagging is below the candle, so this would not be a trade on the 4-hour. The goal we set out to achieve was to take an already profitable system, tweak it, and squeeze even more money out of it. We've done exactly that. We took 36% less trades and at the same time would have made anywhere from 38 to 47% more money. Less work and higher income. It really is like having your cake and eating it too. I've literally handed you a winning strategy on a silver platter, but I know some of you will not be successful with it. There's really two reasons for this. Don't forget that even after filtering, you'll lose over half your trades. Another 15% of positions will be break even. Only 3 out of 10 setups will actually work out. There are people so used to a fixed take profit that letting their winners run will feel uncomfortable. You can't be so eager, snatch your profit at 2 to 1 or 3 to 1. You have to let the trade play out. You may get stopped out at 1 to 1, but it may also run for 10 to 1. There's no way to tell beforehand, so you have to give each trade a fair shot. Most traders lose, not because they don't have a strategy, but because they don't execute the plan. This is mainly due to errors in psychology and risk management. I cover these two topics extensively in my essential playlist. Click here to get started, and I'll talk to you soon.